Is it going to be more of the same in 2016? What do you think?
I think many of these themes are going to continue in. We're looking at more volatility than we've had in the past few years, probably further strengthening of the dollar. Commodities remain under some pressure, and still a difficult environment for U.S. companies that are struggling with slow, sluggish growth, a stronger dollar, weak energy, and declining margins. So there's some opportunities, but it's going to be a tough year compared to, let's say, 2013.
Right. It's certainly going to be a much more uncertain year. So given that, Russ, and I mean, where do when you say opportunities, I mean, is it still going to be in equities?
I think it still is in equities with a couple of caveats. The first is we've had a bull market that's going to enter its 7th year. There are very few places outside of emerging markets that stocks are particularly cheap. So even though we see some good opportunities in Europe and Japan, overall our expectation is that equity returns are going to be on the low side globally. And again, that's a function of valuations being a lot higher than they were at the start of the bull market in the middle of 2009.
We've had interesting correlations, right, so far, Russ. And I know we've got some charts. Guys, let's throw up some of these charts that we have, in tandem with Russ's outlook for 2016. So the dollar, as you mentioned, that has continued to rise given where we've seen with rates. So do you expect, that the Fed is most definitely going to raise rates next week, given what we've seen in the last few days? And what do you expect in the next year?
Well, we think the Fed is going to start to raise rates. It's high time that cycle started. We have an economy that's still slower than it typically has been, but it's strong enough that the policy rate should not be zero. The question is the pace of hikes in 2016. We think it's modest, but the dollar's still likely to appreciate because it's not just what the Fed is doing, it's also what the other central banks are doing. And what's so different about this cycle is that as the Fed begins to tighten, many of the other world central banks, particularly in Europe, Japan, and China, are going to be easing very aggressively. And that's that divergence that gives the dollar the lift.
And I think we've got a next chart here on China. Guys, let's bring that up. I know, Russ, you can't see this, but we have here that emerging market exports, earnings, commodity prices, those are all going to remain attached to China, as they have been over the last basically 15 years or so or more.
Well, certainly there are a number of commodities that are going to be very China dependent. Iron ore, some of the industrial metals, and as China transitions from an economy driven by fixed investment to consumption, the demand for many of those industrial metals is going to go down. That said, I don't think it's all about China. If we think about the broader emerging market space, there are a number of countries that actually stand to benefit from some of these trends. So, for example, lower commodity prices. India imports about 85% of their oil. Lower energy prices is a very significant tailwind for the Indian economy. We've seen, actually faster growth out of India than China in recent quarters.
But that's very different from what we just heard from Ruchir Sharma at Morgan Stanley, Russ, who said he believes with emerging markets, China is the big shoe to drop and the one determinant about where emerging markets go. He notes that, we're still waiting for, is the yuan going to fall even further, and what are they going to do about their debt that's blowing up?
Well, I guess I'd argue a little bit with the terminology. I'm not sure the debt's blowing up. There's certainly a debt problem in China. But let's also remember, China has significant assets. You've got reserves of about $3.5 trillion. The net amount of debt is manageable relative to the size of the economy. It doesn't mean China won't be a source of risk. It doesn't mean China won't continue to slow. But I think I differ with the notion that China represents all of EM. This is becoming a more heterogeneous space with commodity importers as well as exporters and countries that have been very, or at least better about embracing reform for some of the backsliders.
Okay, and Russ, we're always trying to figure out, right, what are the big black swan moments that are going to derail all of us? And we have some of these, known unknowns, things to watch in 2016. So you've got the presidential elections, the Brazilian debt downgrade, possible debt downgrade, Middle East crisis, and China, as we just talked about, slowing economy. What do you think is the most risky known unknown here?
I think they are the types of geopolitical risks that you just described, although I don't think the U.S. election is a significant risk.
Okay.
Instead, I think it's from outside of the United States. Certainly, China is one risk. The other is Europe. We've got a lot of events coming up in Europe. We've got a referendum on the U.K.'s place within the EU coming up this summer. You've got elections that people start to focus on in Germany and France in early 2016. 17. And then finally, you've got this unknown about how the largest refugee crisis since the Second World War is going to affect European politics. And that's another issue I think bears watching.